Good morning, ladies and gentlemen. My name is Ben Klutsey, Program Manager of the Financial Markets Working Group at the Mercatus Center at George Mason University. And I'd like to welcome you all to today's event, Financing the Future, the Role of the Financial System in Fostering Economic Growth. I'll be your host for today, so you'll see me up here quite frequently. Our discussions today will be engaging, will be informative, and I trust that by the time we are done here, you'll be completely convinced of the value of the financial market system in individuals' lives, in institutions' lives, and the entire economy. Before we get our panel discussions going, we're going to kick things off with a keynote from a very important legislator. Since his election to Congress in 2002, he's been a very, very active member of the House Financial Services Committee. Congressman Scott Garrett has also been very active on a number of subcommittees, including capital markets, insurance, and government-sponsored entities, financial institutions and consumer credit, housing and community opportunity, as well as the Oversight and Investigations Subcommittee. At the start of the 113th Congress, Congressman Scott Garrett was selected to serve as the chairman of the Subcommittee on Capital Markets, Insurance, and Government-Sponsored Entities. He's been a primary architect of a number of alternative reform bills, including derivatives and government-sponsored entity reforms. He cares a lot about transparency and accountability, and he has helped to shed light on a number of institutional challenges that we face with our new regulatory financial institutions. This is a policymaker who has a profound understanding of the length and breadth of our financial system and has grappled with some important regulatory issues that have come before the committees he has been serving on. We are very glad and honored to have one of the most perceptive minds on our financial system speak with us this morning. Ladies and gentlemen, please join me in welcoming Congressman Scott Garrett.
Whoa, that's a nice introduction. Engaging and informative. So you set the bar. That'll be for all the speakers that follow me, as I was saying, Tom here. So I appreciate the invitation to be with you all this morning. And Ben, very much appreciate that kind over-the-top introduction. And also, I'd like to thank the center as well, all the scholars, all the staff of the center for the tremendous work, if you think about it, that you have done not just now, but over the years, because they advocate for the policies that to do a couple things, to promote economic freedom and to promote accountability as well on this forum in Washington, D.C. as well. Two principles, I believe, that are not mutually exclusive. Now, as some of you have been here for a long time, engaged in the policy area, as you know, after that nice introduction, you know I've been engaged in it for a long time as well, engaged in it in the area of the financial sector. I can tell you that the work that the center does has been instrumental, invaluable to Congress in general, but more specifically to our committee as we work on the committee, on the subcommittee and the full committee, to try to fight to hold Washington accountable, and as you indicated, Ben, to try to make it a little bit more transparent. And also, at the end goal of all this is to do what? To try to grow the economy, make the economy and the grow and prosper. As we come here today, we're looking at an anniversary. We're looking at the anniversary of Dodd-Frank coming up, 5 years since the passage of the act. I'm not exactly sure what we're planning yet to not celebrate, but to recognize that birthday as it comes along. But I can tell you this, that in our committee, and we sit around as the subcommittee chairmen on a weekly basis, I can tell you this much, that we will be spending time on it. We will be spending time in July on it. We will be focusing on the anniversary. We will be focusing again on highlighting many of the harmful consequences that particular 2,000-page law has wrought on our economy. And as I look at the panel discussions later on for the rest of the day, I think you'll hear a lot about that, the problems that has created both from a regulatory point of view and in the private sector as well. So the topic of today's conference, the role of the financial system in fostering economic growth, could not be a more timely one and more important to overall for economic growth and more important to our committee as well. So if we step back for 1 second. Robust economic growth, what you're focusing on, what does it require? I think there's just 3 basic things to it. Healthy and dynamic capital markets, one, and I'm the chair of the Capital Markets Committee. The ability to access credit and therefore intermediation, and of course, strong competition as well. So those are the 3 principles legs that we stand on. And throughout history, policies that were mindful of these 3 economic principles or pillars, these truths, if you will, we recognized in this country their importance, and our policies from a governmental point of view recognize them in fostering a financial sector that has become, many would say, the envy of the world. The United States is, of course, still the home of the deepest and most liquid capital markets in the world, largely because of our government recognized for decades, if you will, that America's capital markets give a unique competitive advantage throughout the world. So, unlike other economies, notably right now in Europe, all you have to do is open the papers. In Europe, they depend on what? A handful of mega banks for financing, whereas the United States has benefited from a diverse and a dynamic financial sector that has directly contributed to wealth creation and opportunities, obviously, for millions of Americans and job creation. Unfortunately, over the last half a dozen years, many regulators and politicians as well have unfortunately forgotten the role that our markets play in economic growth. In particular, this administration, the Obama administration policies have basically green-lighted, if you will, a heavy, heavy hand of government to intervene and basically micromanage economic decision-making that should be left where? To the market participants themselves. And ironically, it was these same regulators who are now trying to micro-market the system right now, and these same politicians that were the ones who failed to prevent the last crisis. Through Dodd-Frank now and other means, they are now trying to impose additional regulations going forward and asking for more money and more authority to do so. I'm sure that some of you, maybe few of you, maybe no one, can recall back to 2009, Paul Volcker said at that time, he remarked that the only useful innovation in the financial sector in recent memory was, remember what he said? ATM. The ATM, yeah, you do remember. I would hope that his remarks were, maybe a little bit of hyperbole in that speech. But I do think they were, in many ways, broadly representative of a fundamentally misguided worldview shared by many that prevailed at the time. And unfortunately, as you see in Washington today, it still continues today. Why? The thinking goes that anything that isn't simply plain vanilla, if you will, or which can be classified as outside of traditional banking is inherently too risky, and it needs to either be stamped out entirely or come under increasing government control. And to see just how successful this worldview is now, one needs to look no further than recent economic data. Just a few weeks ago, we heard the somewhat sobering news that in the first quarter of this year, our economy actually did what? It shrank by about 0.7%, despite the fact that the last 7 years have seen an unprecedented amount of monetary and fiscal stimulus pumped into the economy out of Washington. And so now it seems that every week we experience a weak quarter or a weak trend growth. And what happens from the administration and their PR arm? Well, they pull out all sorts of excuses. They blame the weather. They blame Congress. They blame the notion that there's not been enough stimulus coming from Washington. They blame anybody else but their failed economic policies. But the fact of the matter is our economy is struggling and will continue to struggle, and it is specifically because of the failed policies that have increased power in Washington at the expense of the private sector and the economy. And it's by no means a coincidence that the weakest recovery that we're in since World War II has coincided with the expansion of this unchecked regulatory power and is given to the financial regulators that has failed to prevent the last crisis. So, in order to have growth, you must have those willing to invest capital with the expectation of a future return. So let's turn then to some of the regulations and regulators that we have now. So you have FSOC, FSB. If you look at those entities, nowhere has this unchecked regulatory power manifests itself greater than in creation of FSOC, which is the Financial Stability Oversight Council. FSOC, and its most influential and most vocal member, of course, which is the Federal Reserve, has basically for the last 5 years been on a mission. And their mission is to do what? Is to identify and root out all risk in the financial system, all in the name of safety and soundness, and all in the name of greater government control. There's a saying that to a hammer, everything is a nail, and for FSOC, everything is risk. So FSOC and the Fed have worked in tandem, basically, to try and gain control over more and more of our capital markets in order to regulate them as if each of these different areas of the financial markets were exactly identical to a bank, which, of course, we know they are not. Regulators then have chosen, of course, begun to refer to our capital markets pejoratively. They call it, outside of this realm, a shadow banking. In doing so, what they're doing is trying to come up, and they have come up with a somewhat sinister term, to try and strike fear in the hearts of the public and justify their request for more authority and more money to regulate these areas. I was thinking about this, and I thought maybe what we should have come up with is a more positive term, such as free-range banking. And this would be something that the left could agree with. So we're going to work on that. But I think the greater threat now to our markets and economic prospects is not the shadow banking, but the shadow regulatory system. And this shadow regulatory system basically operates largely in the dark, and it fails to engage in the public in any way, or in Congress as well. And that is exactly what FSOC is about. And that's exactly how FSOC has been operating. And if you look at it, particularly in regards to its efforts right now to designate certain institutions as systemically important, and to bring them under the regulation entirely of FSOC and the Federal Reserve, which is why we've been having some legislation, which I can go on later on to try to peel this back. Conveniently for FSOC and Dodd-Frank, Dodd-Frank legislation, if you dig into it, they provide certain exemptions for them. They exempted that council from the same transparency rules and regulations that apply basically across the board to every other regulator. But you don't have that now because of Dodd-Frank with FSOC. And so what has this done? This has allowed the FSOC to basically strong-arm some of the council members into carrying out whatever policies, members of the FSOC entity, to whatever policies the administration wants to implement. Even more troubling than that, perhaps, is this, well, somewhat of a cozy and ever-developing relationship between FSOC and the FSB. The FSB is the Financial Stability Board. And by this relationship, they increase the likelihood that a foreign or European-style regulation in the financial sector will be imported from there through FSB, through the back door, here into the United States. See, the FSB, a council of international regulators, which has no ability on its own to enforce its directives and has no legal standing in the United States, has, despite that, in many ways been the tip of the spear, if you will, in efforts by central banks around the world and other regulators who want to create a proverbial new world order of financial regulation. Incredibly, or maybe not so incredibly, the Obama administration has either ceded authority to FSB or worse, has been complicit in decisions made by the FSB to designate certain U.S. companies as systemically important. And if you've watched our hearings on this, you've probably seen us try to get to the process by which our nation works in a consensus manner with FSB through Secretary Lew and Secretary Yellen during the panel discussions that we've had with them. And matter of fact, Secretary Lew will be up later on today. We have never been able to get a clear and a concise or any answer whatsoever from Secretary Lew, specifically what consensus means and what his efforts are as far as working in a complicit manner with the FSB. In its most recent consultative document regarding their work with SSB, in their designation, the FSB pointed a direct target at where? Asset managers and investment funds, and said that these entities threaten our global economy. And so what you're having occurring right now is a backdoor approach through FSB, then through FSOC, to basically designate asset managers and investment funds, which basically, if you understand them, have no systemic relevance and importance to the economy at all, as systemically important, and they're doing it by a backdoor approach. This is despite a warning come from policymakers on both sides of the Atlantic that it should not occur. Should the FSB, which of course counts Treasury and the Fed as members, march forward in such designations of these entities, what happens? Well, we run the risk of imposing as I said before, a European or Euro-centric capital market system on this country and other rules on the US. And what would that do? What that would do would severely restrict the ability of our capital markets to play the important historical role, as I mentioned at the beginning of my remarks, with regard to our economy. Moreover, it appears FSOC and other bodies are ignoring the warnings that have been sounded by FSOC's own financial arm, which is the Office of Financial Research, the OFR. Take a look at this. In its recent issued annual report, the OFR identified a number of threats to the stability of our financial system that have risen over the years. So the OFR basically is an arm of FSOC. They come out with this report, and what do they say is the areas that FSOC should be looking at? Well, they say there's 3. These are their top threats, they say. 1, the Federal Reserve's easy money policy, which has contributed to excess risk-taking. 2, a reduction in liquidity, which has caused markets to become more fragile. And 3, a migration of financial intermediation and other activity in the so-called shadow banking system, or the free-range system, where threats are more difficult to assess because of information is less available. If you think about those 3 that I just ran through for you, what is the common theme throughout all the threats? And of course it is, each one of them is a direct result of government action and intervention into our marketplace. Now, what follows from this? Pick up any newspaper right now on any given day, and you're bound to read an article about the growing problem of liquidity in the fixed income markets. And the potential that this tightening in those markets will create is an economic downturn or potential even the next financial crisis. Why is this all coming out right now? Because all these entities are trying to be in the press to say, do this to avoid blame later on. At least they talked about it now, but they're not doing anything about it. These issues in the fixed income markets are what? A direct result of the confluence of several different things. First, the Volcker Rule, Basel capital requirements, and a whole series of other regulations that effectively have shifted risk in the marketplace from banks' balance sheets to other areas of the market. So I've been giving you various quotes. One of the other quotes we can use is Santayana's quote, "Those who ignore history are condemned to repeat it." I think that quote is playing out again today as government action is once again leading us towards to another potential major economic meltdown. Their own studies are showing it, but they're taking no actions. And instead of addressing these issues head on and admitting failure, FSOC spends its time in its recently issued annual report taking aim at recent innovations in the financial market. For example, the annual report talks at length about the supposed risk of, if you're familiar with it, peer-to-peer lending, a relatively new industry that helps connect savers and borrowers through reduced intermediation costs. So you have to step back for a moment and ask yourself, is peer-to-peer lending really a topic worthy of FSOC's attention when the real threats are those that we just came out in their own report? So this is what happens when you give such unbridled authority to a group of regulators. They essentially will try to smother any kind of innovation that disrupts the current way things have done, the current way of thinking, to ultimately the detriment of the economy. Finally, what we deal with in our committee a lot, SEC, capital formation. So in addition to holding FSOC and the FSB accountable, we must also work to create opportunities for small and medium-sized companies to raise capital in order to support their long-term growth. And for decades, the SEC, Securities and Exchange Commission, has continuously, unfortunately, failed to update their own security laws in order to help those small and emerging companies access the capital that they need to grow and hire new employees. So what do we do about that? So since 2011, our subcommittee and our committee, the Capital Markets Subcommittee, has led the effort, led the charge, if you will, to bring our security laws into the 21st century. And we began that with passage of a number of pieces of legislation and some that have been signed into law, such as the Jobs Act of 2012. And as a side note, we have already seen some of the benefits of Congress taking action. In 2014 was actually the best year for IPOs in over a decade. And small companies already are taking advantage of some of the law's other provisions, this despite the fact that the SEC apparently refuses to actually write and finish the regulations that they were directed to in a bipartisan manner. But we have seen an uptick because of the laws that Congress has passed, such as jobs. But with all that said, there is more that can and should be done. Last month, our committee approved about a dozen pieces, 13 pieces of legislation, most of them in a bipartisan manner. And they would build upon the success of the Jobs Act by making our markets freer and reducing the role of government in Washington in the private sector markets. And some of these bills, or most of these bills actually, have huge bipartisan support. And most of them have, or some of them have Senate counterparts. And because of that, we're hopeful that we can actually move them through sub and full in the House and through the Senate and through the whole process and up to the President's desk to decide whether he wants to come down on the side of economic growth or listen to the special interests that have been trying to stifle our capital markets and their formation for years. So with all that being said, clearly there's a lot to be done. And we on the Financial Services Committee, both all our subcommittees and the full committee in Congress, have our work cut out for us when it comes to holding regulators accountable and ensuring that our financial system continues to play an important role that it has not only in this country but in the world as well historically. And we cannot allow our economy to be undermined, if you will, by unelected and also very unaccountable regulators who continue to think up ways to basically interfere with the innovation and the risk takers in our economy. So with that said, I want to again thank you for the nice introduction at the beginning. Thank you for the opportunity to come out here. And I looked at your program for the rest of the day. I wish you well for the rest of the program. Thank you so very much for the kind hospitality.
Please join me in thanking Congressman Scott Garrett again for his very prescient remarks. You will notice some of the items that he mentioned in his remarks throughout the entire program: access to credit, healthy and a dynamic system, as well as competition. The Mercatus Center at George Mason University is a university-based research center. We have a goal to bridge the gap between academia and policy. We have a goal to shed light on policy challenges and policy questions using academic research. We've also been a source of market-oriented ideas for a few decades now. And if you look at the financial policy world, it could certainly use a dose of market-oriented ideas. In our conversations today, we want to highlight the nerve center of the economy, the financial system. And we want to recognize that it does fuel innovation and it does foster economic growth. All of us remember the financial crisis that occurred about 8 years ago. It was something that emerged in the housing market and then cascaded throughout the entire financial system. It became a global financial crisis. And then the after effects were devastating. Some have called it the Great Recession. These were very challenging times for consumers, producers, and for jobs in general. The crisis led many to question the utility of our financial market system. And I bet if we did a quick poll here, we would get some healthy skepticism about our financial system. There are two polls that I want to mention this morning. In a recent poll, the respondents were asked about financial innovation and whether it boosts economic growth. 57% said they disagreed that financial innovation boosts economic growth. And these are readers of The Economist, not an unsympathetic crowd. In the second poll, adult Americans were asked, how much, if at all, do you think the U.S. financial system benefits or hurts the economy? 48% said it hurts the economy. That's nearly half of U.S. adults. But research shows something different. research tells us that the financial system is critical in advancing economic opportunities and economic growth. I think to get to the heart of finance and the role it plays in our society, we have to think about the origins of the word finance. Finance comes from a Latin word, finis, which means goal or end. It gives us an idea that the role of finance is to help us structure our goals and help us get to the goals and dreams that we have set. Nobel laureate Robert Shiller puts it perfectly. He says, finance is the science of goal architecture. So it is the underlying set of structures or building blocks that make our ideas come into fruition. In ancient societies, access to capital was only limited to craftsmen, priests, rulers, and merchants. If you were not in any of these categories, you'd have a really challenging time getting access to capital. There were tons of middlemen, tons of loan brokers. They made interest rates extremely high. Imagine you had a business idea in such a society. You'd really have a challenging time getting it off the ground. The modern financial system that we have now is a product of a series of market revolutions to democratize access to capital. In the late 19th and early 20th centuries, East Coast bankers catered primarily to large corporations and large institutions. However, there was a man by the name A.P. Giannini who emerged from the West Coast. He was the son of Italian immigrant farmers. He sought to start a bank and cater to immigrants, cater to small borrowers, small deposits. He started off with about $700 in deposits. A year later, he ended up with about $700,000 in deposits. In today's dollars, that's about $2 to $3 million. By 1945, Giannini's Transamerica had become the largest bank in America. His efforts to democratize commercial banking contributed to the growth of California's agricultural economy, to California's entertainment industry, and actually helped to bankroll the initial Disney film productions. And there are many examples of such efforts to help democratize access to capital and to ensure that people from all walks of life can have access to the financial system that we have. These examples include peer-to-peer lending, as Congressman Scott Garrett mentioned, crowdfunding platforms, and many other revolutions. All these things contribute to improving access to finance and democratizing the process of obtaining capital. So, individual and organizational goals that require important investments, whether it's starting a niche restaurant, developing a new product, building office space, research and development, or investing in human capital, can be realized with the tools of finance. In addition, finance is more than allocating capital. One of the great things about modern finance is that the web of intermediaries and the web of transactions help to manage risk as well. Think about the farmer who enters into a futures contract to protect himself against future drops in prices. Think about the airline company that uses futures contracts to manage the potential for increases in oil prices. Finance can transform ideas into new industries, technologies that can improve lives through life-changing innovations and jobs. And what we want to discuss today is how we can keep the financial market system vibrant and to spur economic growth. You may already see how this can affect economic growth. The combined investments, the totals to investments that are being made by individuals and institutions pursuing their goals eventually add up to generate outputs and income, leading to overall growth in the economy. And a number of empirical studies highlight the positive and profound effects of consumer and business finance on economic growth. The bottom line is this: the countries that foster deep, broad financial institutions and markets will likely improve their growth conditions. Comparisons among countries show that nations that have more developed financial markets see faster aggregate growth and improve their incomes over time. Further, recent empirical estimates suggest that if emerging nations double bank credit to the private sector as a percentage of GDP, they could increase annual GDP growth by almost 3%. Doubling the trading volume in their securities markets would increase GDP growth by 2%. The American financial system is unique. In particular, it's very unique in its depth and diversity and offers a plethora of opportunities for investors, entrepreneurs to access capital. Hence, growth in our economy is linked, I'd argue, inextricably to the effective functioning of our financial market system. And this is why we're here today. We want to explore two main questions. One, how the financial market system matters for generating investments in novel ideas. And two, whether the current reforms in financial regulations would facilitate those innovations and lead to economic growth. At this juncture, I'd like to introduce our next speaker. He is someone who intimately understands the role that finance plays in our economy. In fact, I'd say he's really an embodiment of the bridge between academia and the policy world that we talk about at Mercatus. Dr. Manuel Johnson is a friend of the Mercatus Center and a friend of George Mason University as well. Currently, he's a member of the Mercatus Center's board of directors. He is also co-chairman and senior partner at Johnson Smith International, an investment and consulting firm. From 1977 to 1994, he was a professor of economics at George Mason University, and during this period, he served as Assistant Secretary of the Treasury and Deputy Assistant Secretary of the Treasury. At the Treasury Department, he played an important role in designing the Tax Act of 1981 and the Tax Reform Act of 1986, which was the most dramatic change in U.S. tax law at that time. His performance won him the department's highest honor, the Alexander Hamilton Award. Dr. Johnson also served as Vice Chairman of the Federal Reserve from August 1986 to August 1990. He has published 5 books and numerous articles. Clearly, he's a prolific writer as well. He has served on 3 presidential commissions and served as Chairman of the Financial Accounting Foundation. In 2010, Troy University, his alma mater, announced the founding of the Manuel H. Johnson Center for Political Economy, which examines the role free markets play in promoting economic development and prosperity. Evidently, Dr. Johnson's background is an indication of the unique perspective he has about our financial system and its role in our economy. Ladies and gentlemen, please help me welcome Dr. Johnson.
Thanks a lot, Ben, for a more than kind introduction. Some of that seems like ancient history now. It's been a long time since I've been in public policy role. Like I say, I left in 1990, but that's given me the experience of being in private business and seeing the relationship between public policy and a smoothly functioning financial system and how important that is. So I want to applaud first the Mercatus Center and George Mason University for sponsoring what I think is a very important and timely conference on the role that financial services play in fostering economic growth. This is a key point that needs to be emphasized and made. I think, as Ben pointed out, now if you do polling about the role of the financial services sector in the economy and how people feel about it, sometimes greater than 50% feel that it's a counterproductive process and is not contributing to, the growth of our economic system. And so I think, that tells you a lot about how much we need to focus on this issue. As has been pointed out by Congressman Garrett in his important remarks, financial system plays a lot of key roles. And of course, you know, the fundamental point is that it is an intermediation system that channels the hard-earned savings of households into what we hope is their most productive uses. And I say what we hope is their most productive uses because it doesn't, those funds, those hard-earned funds don't always get to the right places. And why is that the case? I contend that a lot of that is primarily because of failures in the regulatory process and the fact that we have depended more and more on a safety net to protect safety and soundness of the financial system, which has actually turned out to serve just the opposite role. And because of this, I want to emphasize the point that that we often miss, and that is the key role that risk-taking and the potential for failure plays in providing this role of channeling hard-earned savings into the most productive uses in our society. When savings goes into the financial system, if it doesn't get allocated correctly through this transmission mechanism, if those serving in the financial sector don't understand correctly the risk and reward system. And that always works best when we have freer markets where pricing can reflect interest rates and rates of return on various productive possibilities, reflect accurately the risk and rewards associated with those actions. And so if we don't have a smoothly functioning pricing mechanism to indicate how to allocate those resources, the chances of those resources being misallocated into more risky activities or just simply unproductive activities is higher and higher. And I think that that's something that I think we've been missing in where things have been going now. You know, it reminds me of a story when back in my central banking days, when I used to go to Basel, Switzerland to meet at the Bank for International Settlements. That was kind of the fraternity of central bankers headquarters, where we discussed a lot of global financial problems for central bankers. But once a year we met with, and this is before the Iron Curtain fell. That's how old I am. And once a year we would meet in Basel with central bankers, and I call them central bankers because they thought of themselves that way, from behind the Iron Curtain, Eastern Europe, Soviet Union, all of these places. And of course I developed a friendship with this young central banker from Bulgaria, a very nice man. We had dinner together, and you know, he pointed out, and this was a bright guy, very bright guy, and he pointed out that you know, what was wrong with their system. It always hit me so clearly. He said, you know, I said, how does central banking function in Bulgaria? And he said, well, you know, it's just amazing. I mean, he said, you know, what we basically are is a granting agency. We sit around and listen to proposals from various cronies in the system presenting funding proposals for various projects they have in mind. And those projects were driven by what they thought the state wanted to see. Very elaborate, well-constructed grant proposals for funding. But he knew this, and he pointed out that, you know, what was wrong with that is it was doomed to failure because none of this was in touch with the consuming public or what they wanted or what society needed. It was all based on the managers of the state and their desires and wishes, and nothing to do with a market system and the demands and needs of the consuming public. He knew why our system worked better. It was very clear. This was probably 1987, 88. And of course, for all those reasons, that system collapsed. And yet, here we are almost trying to reinvent something like this in the name of protecting safety and soundness. It's just amazing to me. Without the potential for failure and risk-taking, we don't really, and the market function in determining a pricing mechanism, we don't really know how to channel these resources. If we don't have that, then it's a little wonder why the economy doesn't grow or whether it's or that it's subpar in its performance. I would contend that the last crisis was more of a failure of the regulatory process than it was simply irresponsible behavior of bankers. Now, I would say that's a combination. Bankers certainly performed irresponsibly in over-expanding and searching for the highest returns as aggressively as possible. But why did we end up with such an overinvestment cycle? I would contend that, all right, we have Dodd-Frank today to try to prevent something like that, but the truth is all of the power, the regulatory power was in place and already there to have prevented this crisis to start with. The Fed certainly had all the powers they needed to ensure appropriate capital ratios. They had all the regulatory oversight of financial holding companies that existed in their regulatory framework. They certainly could have prevented this if they had foreseen it, but they couldn't foresee it, and it's a little wonder now that, that if they couldn't prevent a crisis pre-Dodd-Frank with a smaller safety net that they had then and a smaller regulatory framework, what is going to happen with a larger framework, a larger safety net today? If it was impossible to foresee the problems that existed in the financial crisis then, how are they going to see it now? And I think the answer is they can't, and they know they can't, and so they try to prevent risk-taking in every way possible. And that is simply the end of our system if we continue along this path, because we're not going to get the right signals for the financial system to properly intermediate between savings and productive uses of funds. So, I can't emphasize enough how important that role is. Now, I don't want to condemn Dodd-Frank completely. It's a natural reaction to a very deep crisis. And in fact, most of the research that's been done on business cycles has pointed out that recessions are deeper and longer associated with financial crises that were originated from financial crises than they were from like inventory cycles or other types of cyclical problems. So it's a little wonder that we're concerned about financial crises. But some good things have come out of Dodd-Frank, like the focus on living wills and the way to provide roadmaps for the management of failed institutions. I think that's a proper focus. The effort to provide more transparency and more capital in the industry is also appropriate. But all of these powers were available to central bankers and regulators before. They could have demanded those things on their own with their regulatory authority. And instead, it's taken legislation for some of that. But in many ways, we've overextended the regulatory process and created more problems and damaged our pricing mechanism and completely stamped out the potential for failure. And I think that's one of our biggest problems. I mean, if we don't get back to a risk and reward structure by scaling back the federal safety net, I just don't think we can have the kind of economic performance that will keep our this country or the industrial world functioning in a highly productive fashion. And I think that that's, I think, the focus of the panel discussions today. You know, how do we recover this? How should we recover it? What's the proper approach to regulatory reform to get back there? You know, I look forward to hearing what the panelists have to say about that, and where and some of the proposals that we might evaluate to get back to this point. But if we don't, I think we're destined to continue to see struggling industrial economies. Clearly, Europe and even China, as a new emerging economy, are struggling with this issue even more than the United States today. So I applaud the efforts of Mercatus and George Mason to focus on this issue, and I look forward to hearing some of the panel discussions and some of the ideas that come out of this this conference to try and get us back to a smoothly functioning financial system that does intermediate efficiently between hard-earned savings of households and their most productive uses in society. So I look forward to the conference, and good luck. Thank you.